Thank you everybody for taking time out of your day to come to the webinar this morning. I hope you'll find it educational, instructive, as well as fun. Just quickly, can we do a quick sound check? Can you just write to me, let me know you can hear my voice, you can see my... All right, Gavin says all good. Excellent. All right, well, let's get this party started. Essential trade management principles. As usual, let's just go through the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, we've been through a few webinars now. You know all there is to know about me. Spent most of my career on the retail side until I finally graduated, and after committing every mistake in the book twice, I finally learned and graduated into the institutional side, sending signals to institutional clients with 3C analysis and working here at FCI, developing traders, preparing the Trader Academy, and providing content such as these webinars that I'm really glad and honored to know that you're watching and that you're enjoying. Let me just reiterate what our objective is here at FCI Markets. These aren't just simple webinars to entertain you. We are always looking for passionate traders to expand our trading desk here in the UK. So all the information we're giving you is, it's tangible, it's useful information that has been discussed and reviewed by the team here at FCI Markets, because we really want to help you simplify and clarify your trading and just give you the tools to become more consistent traders, because hopefully you will be able to join us, get funded, and become professional traders. So today we're going to talk about trade management principles. Now, the starting point here is that the internet is full of trading wisdom, such as ride your winners and cut your losses. And trading books, the market wizards, anybody, professional gamblers, they all know that you need to ride your winners and cut your losses. But what actually happens? This is a random screenshot that I took from FXstat. And FXstat is another one of those portals similar to MyFXBook, where traders have the possibility to insert their track records and track their trading stats as they trade, as they go along. So this is just a random extraction from FXstat. And what you see here is that the win-loss ratio of this trader is almost 100%. So in reality, initially you might think, well, that's great. This guy never loses. However, take a look here. Only 3% of his losing days accounted for a huge loss, whereas his best trades of the amount of his worst trades. So, what are we actually seeing here? Okay, we're seeing a trader, just like many others, that is afraid to lose. We're seeing a trader that obviously doesn't have a profitable average win to average loss rate. Okay, it's a trader that obviously runs his losses and takes quick profits. So his entire trading career actually hinges on his win rate. Okay, so it's just flipping that whole trading wisdom on its head. Instead of running profits and cutting losses, these people traders like this are probably holding on to losses and closing profits very quickly, having these phenomenal win rates, but in reality having no real limit on losses. Because the question here is, what happens if instead of having 8 losing days, this trader had 16 losing days or more? What happens if there are more losses. Just how far can this go? Because we know that everywhere from on the daily or weekly level here, you're running his losses and putting a cap on his profits. So you have to ask yourself, how bad can bad get? Is this person really delivering good risk-adjusted returns? Because that's what trading is all about. Now, trading is very similar to professional gambling because each single trade, is basically a random extraction. You never know what's going to happen on a single model. Will give you an edge over time, over a sequence of trades. But each trade is basically a random extraction. So trying to force a win on every trade just goes against all the proper principles of trade execution and trade management. And this is what you see most of the time. This is another screenshot that I took this time from my FX book. And this is what you see with the most popular systems and the most followed systems that everybody is trying to follow because they have the phenomenal win rates, which is of course psychologically soothing, but it's problematic because the system, whatever it's doing, is scalping for 2 or 3 pips. Okay, so there is a cap, there's a roof on the winners here, but on the downside, you can see that when the system has a loss, the loss is 50 times as much as a win. 92 pips on a loss. Now let's just ignore for a moment the fact that the position size is always the same for the wins, and then to recap the losses, this system sort of martingales and it goes overboard on the position sizing. But what happens here? What happens if after this magnitude of the loss, okay, which is 50 times the average gain, and that's not a mistake. It is 50 times the average gain. Okay, so you have to make 50 average profits to make up for one loss. Okay, a negative skew strategy. So you're picking up pennies in front of a steamroller. And what does this system do in order to make up? And it goes for a slightly bigger profit target than normal. But what happens if, by martingaling like this, you get a second loss? Now you're down 100 times the average gain. What is the limit? Now, is this proper position sizing and trade management? What is the real risk of this kind of trading system? Now, the answer is, unfortunately, the real risk is unknown. It's unlimited, because the system could martingale its way down and never recover. So let's take traders that want to have the psychologically soothing high win rate also put a ton of pressure on themselves. Okay, so it ends up being a vicious circle because they need to be right. When you have a high win rate, usually your losses are small compared to your gains. So you actually need to be right. You put yourself in a position where you have a ton of pressure because you can't allow yourself to make a mistake. And even if you do, in the markets, you can do everything right and still lose. So you just can't allow yourself to lose. You can't, there's no room. This just creates a vicious cycle, in your mind where you need to be right because your account just can't withstand the losses. And this is a bad place to be for traders. Now, what we need to do is we need to break the vicious cycle by starting from the opposite, just on the opposite side of the lake. Now, you know that you need to have a high average win to average loss ratio. Your wins they really do need to be larger than your losses, because the more you can ride your winners, the more you allow your trade to mature. Or what I should say is, the more you allow the trades that go in your favor to run, because you can't control what the trade's going to do. But the more you allow it to run, and the more you will cut the losing trades at the knees, and you don't allow them to mature, the less pressure to absorb losses. Because if you have, for example, an average win to average loss ratio that's around 3-to-1, then you only need to win 33% of the time. And a decent trading system has a 40 to 50% win rate. Okay, so you should be in a rather comfortable place. And this chart here is to illustrate that point. Okay, it's a relationship between the win rate and the risk to reward ratio. So the higher the risk to reward on your trades, the higher the average risk to reward on your trades, the lower the break-even win rate is. Okay, so the break-even win rate is basically what percentage of even. Okay, so obviously, if your risk to reward is just 0.5, so not even 1. Okay, you're not even getting a decent. You're not even returning as much as you risked. So you risk $50 to make $50. In this case, you're risking 50 to make 25. At a risk to reward of 1, it's like you're risking 50 to make 50, and so on and so forth. At 2, you're risking 50 to make 100. At 3, you're risking 50 to make 150. So that's where we need to be, because as traders, we really need to stock. I mean, all that work that you do, all the pre-trade preparation, trying to stack the odds, studying your entries, studying market types, studying trade execution, trade management, all this is to help you only get in the markets when the odds are in your favor. So when you know that your system gives you an edge, and and then when you do have your edge, when it does appear, you should try to manage your trades in such a way that you're running your profits and you're cutting your losses at the knees. So that way you reduce pressure, and it creates a virtuous cycle. It creates a functional cycle, because at that point you don't have any pressure to win. You can patiently wait for the better opportunities to arise, because nobody is sitting there with a gun at your head forcing you to trade each and every day. Okay, so you have patience, you have less pressure, and obviously your body works better, because without pressure you're not as stressed, and without that same amount of stress, your mind is more capable of absorbing information, digesting it, and observing things from an objective point of view, instead of all the tricks that our minds play on us when we're stressed. Now, talking about risk, and keeping in mind that system that I just showed you before that had a loss which is 92 pips, whereas his gains are on average 3 pips, 2 or 3 pips. Okay, keep in mind that kind of system, and just how much you need to recover based on your drawdown. Okay, so this is the drawdown. Okay, this is the amount you're losing, okay, in your account, and this is the required gain. Okay, so what you're seeing here is that drawdown recovery becomes an exponential battle against you. Okay, that is why, which means it just gets tougher and tougher and tougher into the hole. And unfortunately, there is the adage that 90% of traders lose 90% of their capital in 90 days. These are from broker statistics. It's true, because most people that come to the markets attempt to gamble, and they don't take into consideration the fact that the further down they go, the more difficult it is to recover. And you may never recover a 60-70% loss. As traders, our focus needs to be on limiting risk. I mean, drawdowns should be on a monthly basis. Okay, if you're looking to get funded, your drawdowns should be around 3% on a monthly basis, at a maximum. Because if you try to keep your drawdowns small, even if they do exceed the quota just a little bit, you know that because your whole mindset is about limiting risk. But if your mindset is opposite to that, it's like, well, okay, I'm in a drawdown. Let me just double my risk. Let me double the money on the next trade and try and make it all back. That's gambling. That's martingale, and that's the quick route to the poorhouse. That's just the opposite of what we're trying to do. Okay, so that's why you should always be skeptical when you see traders saying, yes, I'm working with a drawdown recovery model. Most drawdown recovery models boil down to a martingale position after each loss, okay? Because they sort of believe that if they get 7 losses in a row, the next one is much more likely to be a profit. But in reality, the distribution of profits and losses is random. So, even if there's a certain dependency amongst your trades, you never have that certainty. So you are always risking, ruin. You're risking losing all your chips by thinking this way. And, plus a few principles. By using this kind of drawdown recovery model, even if you had infinite capital at your disposal, at best, you break even. So the system that we saw before had a 92 pip loss with, it was trading 55 lots. And so it was like a $50,000 loss. And then what it does is it trades 385 lots and it makes 13 pips. So it breaks even. It makes back that loss. But again, what happens if you don't win? What happens if that sort of recovery attempt goes bad? So now you're down, 100,000 and your average trade is making you 1,000. So what do you do then? It is, it's a vicious cycle, and it's just not the way to trade. And that is why, as we will see later, having a stop loss is an edge. You really have to see your stop loss as an edge, because the smaller you keep your losses, the larger your profits look in proportion. But a stop loss is an edge, and many people unfortunately just don't use it. So the third thing is, doubling down using a martingale system means that you are throwing good money after bad money. And that's just the opposite of cutting losses. Your money should be used on good trades, or your money should be sitting there waiting to be used on good trades. Your money should not be tied up in bad trades. Okay, that's why we really have to think in terms of efficiency and in terms of superior risk-adjusted returns. Okay, and we'll talk about that in a bit when we talk about Sharpe ratios. So we need to have larger gains and smaller losses. Okay, so this does imply the use of a stop loss. So let's talk about the stop loss a little bit. The stop loss affects 3 out of the 4 variables in the expectancy equation. In our previous webinar, if you go back and you see it, on becoming a great execution trader, we talked about having a positive expectancy and what you need for that. Expectancy is average profit times your win percentage minus your average loss times your loss percentage. Okay, so essentially it's your average P&L per trade, and it should be positive because it tells you that over time, on average, you have a positive return on your trades. Now, having a stop loss on your trades can skew your expectancy. Everything else unchanged. If everything else is unchanged, then having a tighter stop loss will change your expectancy. For example, the win percentage. The tighter your stop loss is, the lower your win rate will be, but the larger your gains will be. So if you think of systems like Dunn Capital, okay, D-U-N-N Capital, it's one of the oldest systematic trend following models on the market, and on the institutional market, I should say. And they have a hopelessly low Sharpe ratio, but they have a huge Sortino ratio. Why? Because they have exposed their account to upside volatility because they have huge gains, but they do have a large volatility in their returns. So that means that they're cutting their losses. They're cutting their losses, and then they let their gains mature to a large extent. psychologically, it's very difficult to do, and that's why most of the trend following models that have survived for more than a blue moon, they do have that 35 to 40% win rate, and that's psychologically tough to withstand. But it shows you that there is a math to having a tighter stop loss and letting your wins mature, having those larger gains. Talking about the stop loss, okay, the tighter stop means you have a higher loss rate, but you have smaller losses. So what the tighter stop loss allows you to do, all things else unchanged, is to have a higher average reward to average average gain to average loss ratio. So it means that on average, you can be a bit more relaxed because your gains will make up for multiple losses. And that's a good place to be. Okay, so it's trying to, and you have to train yourself on this because you need to experience it firsthand in order to relax and get your mindset away from needing that high win rate. Okay, it's a matter, it really is a shift in habits and a shift in thinking. But you need to train yourself, you need to experience it firsthand. Otherwise, it won't really sink in. And now the average loss, okay, when we talk about losses and the average loss, that really depends on trade management, not just your initial stop loss, because when we trade, it's not just set and forget. Okay, the trade management is all about dealing with the market's gyrations in real time, depending on what happens. Finally, the stop loss also impacts your position size. So of course, if you have tighter stop losses, then you're going to have larger position sizes. So your profits will be financially more rewarding, and you just have to remember to cut your losses and to make sure that you don't move your stop loss once it's in the market. Okay, because we should never be looking at the money. We should always be looking at the percentage returns that we're making, and even more importantly, the risk to reward on our trades. Okay, we should always be striving for a reward that is more than our initial risk. And that's taking into account the trade management. So, don't hold your trade and hope that they'll turn around. Cut them, because cutting your trades and having a tighter stop loss is an edge, and you free up capital for new trades. So we talked about the average loss being a function of your trade management. Great. Well, let's introduce the principles, the basic principles of trade management. Okay, because not too many people actually go through this on the web. I've done extensive research and I couldn't find much information on the web. So I think what we're giving you here at FCI Markets is some of the only available information on trade management that's out there. So let's dig into it. There are only three things that can happen once you get in the market. Okay, prices can go up, prices can go down, or they can remain the same. So, if you start to think in terms of principles, trade management principles, at a very basic level, your exit strategy needs to answer these questions. If price goes against me, okay, so let's say I'm long and price comes down. What price, or at what level, or what situation will require me to reduce risk? Okay, to scale out a little bit. And how much risk do I take off? Secondly, if price goes in my favor, so I'm long and price goes up, at what price do I scale out? And how much do I scale out? Okay, and what if prices go nowhere? How long am I going to wait before I actually take my chips off the table and say, this isn't doing what it's supposed to do? And I can use that capital for other trades, for better situations. Okay, these are the basic questions you need to answer. If price goes against me, am I going to wait for the initial stop loss to get hit? Well, the answer might be no, because if price goes in your favor a little bit, then comes back down, that's one situation. If price sort of doesn't do anything and then starts to go against you, that's another situation. If price goes almost all the way to your profit target and then starts coming back down, that's another situation. So you need to deal with these situations in a systematic manner, okay, with clear rules, because that's what will give you peace of mind, having clear rules for these various situations. And at a very basic level, remember about the expectancy equation. Your profits will look big in relationship to your losses. So reducing risk before the market actually can help skew that equation in your favor. Instead of taking full 1 hour losses, okay, what would happen to your equity curve if you were able to take 0.5 hour losses or even 0.7 hour losses? Okay, if you were risking 0.5% per trade and you're able to save 0.2%, you're able to avoid taking those big stop losses, and you keep your profit targets where they are, what would happen to your equity curve? Okay, so really, I'm trying to drill this into your mind that you don't need to wait for your for your initial stop loss to get hit. If the conditions are saying that the market is turning around, you can scale out or you can close the trade before it hits your stop loss, because the smaller the loss, the bigger your profits will be in comparison, and you manage your risk well, okay, because you didn't lose as much as you put in. So once again, it's getting into this risk management mentality. Before we get into the nitty-gritty details, let me just spend a couple of words on set and forget, okay? Because a lot of systems that are sold out there, and a lot of other educators, they talk about set and forget. Buy into my model and just set your orders and then forget about the trade, let it go to profit or let it hit your stop loss. Well, I haven't met consistently profitable traders that use a set and forget model. Okay, so the set and forget is definitely better than not having a plan at all or acting emotionally. Set and forget is a plan that requires not intervening, not touching anything. But in my experience, especially going down to the intraday realm, you need to be active. You do need to intervene. You need to manage your trades actively, because what if price goes almost all the way to your target and then reverses? You've thrown away almost your full profit potential. So that's opportunity cost that you've thrown away, and you've lost your initial risk capital. So that is a rather inefficient way to deal with things. And what if price doesn't go anywhere and then it reverses? Once again, you had the opportunity to cut your trade instead of absorbing a full loss. So the set and forget is definitely better than having no plan or acting emotionally, okay? Because a lot of traders still do act emotionally. If they see a profit, they'll take it. They seem to forget about risk reward, about expectancy, and everything we're talking about before. But there's a better way. So before we talk about the principles, let's just go through the examples. This is an example from last week. It's on cable. This chart is from 3C Analysis, our partners here at FCI Markets. Remember that opening a live account here with FCI Markets, you do have the right to receive 3C Analysis for 2 weeks free of charge. So last week we identified a shooting star on cable. So showing exhaustion, buying exhaustion, and a potential reversal in the short term at least, because the daily uptrend is still intact, but in the short term, it's showing a bit of exhaustion. So shooting star, if we are going to trade the next day, how are we going to manage our trade if we get into the market? Okay. Here I'm going to illustrate some practices for intraday objectives, and then I will show you an example if you're trading swing. Okay, so the first principle that we're implicitly learning here is that trade management depends on your objectives. The more time you have to spend in front of the markets, the more you can open up to intraday trades. Now, that doesn't mean that you sit at your desk all day looking for trades. It means that you have the opportunity to wait for the higher probability scenarios to open up and unfold intraday. Whereas people that have less time to dedicate to their trading will have to adopt a swing approach or a longer term approach. Obviously, stop losses, profit targets. So let's go with the intraday objective first. And let's see. So here I use just a typical entry example. It's something that we've shown in previous webinars. It's something that's on our free course that will shortly be available on the FCI website. It's basically looking for a little inside bar on an extreme pullback on the 15-minute chart. Nothing more difficult than that. Very, very simple. So let's imagine entering there. Okay, so it's about 133.75. So you have two different stop loss opportunities here, and they depend on how aggressive you want to be. The first one is just placing your stop loss slightly above, okay, let's say 10 pips above your entry here. Okay, and I say 10 pips above and not just 1 pip above because I believe in giving the market room to wiggle around. You could also put your stop loss up here, okay, above the day's high, so to give it a bit more breathing room. So it's basically 2 swings away. What is the consideration in placing your stop loss and evaluating the risk reward of the situation? Well, basically, since we're playing a pullback, okay, every pullback is basically an expectation of a return to trend and at least reaching the previous swing point. So the previous swing point was down here, okay, the current day lows, Asia lows, current day lows, and they weren't very far away. However, we're trading intraday, so it means capturing even these small 20 pip moves initially, after initial entry if possible. So what you could do is you could say, okay, well, I've got about 20-25 pips potential profit target, so my stop loss should be at a maximum 20-25 pips, and you can place it up there. Or you could say, okay, well, we know price shouldn't really break the swing high, it can violate it, but it shouldn't really start closing above the swing high there. So I can put it just a buffer above the swing high, so half of my potential target, 10 pips, 10 or 15 pips. The choice is personal. I'm giving you the principles. I'm giving you, the structural principles from which you can decide where to place your stop loss, and and what the initial expectation for your trade should be. So the initial expectation is that we get back down there. Okay, and unfortunately that happens. So when this happens, when I personally achieve my first profit target, what I'm doing is I'm looking for potential stalling in momentum. Okay, because if momentum stalls, so for example here we have a bit of a rejection and an inside candle. Okay, that might be it's not really an inside candle, almost. That might be a sign that it's time to scale out a little bit. Take a third of your position off because you've reached your initial your initial target for the trade. What you expected could be done has been done, and now anything on top of that is sort of added gravy. So the consideration is, if my stop loss initially was 20 pips above the high, and I get my 20 pips, okay, my first expected target was hit. What do? Usually I scale out, I take a little bit off, and I leave the rest in the market, because now I've paid for the trade, and if the market goes against me, so if there's a vicious reversal, I can't lose my full risk because I've taken a third off. So in any case, I've managed my risk correctly. And if the market starts to reverse in printing higher lows, something that looks really bad for shorts, I can decide to cut my trade at or near break even or scratch it. I have flexibility, okay, within certain boundaries. So the principles are, number one, I'm looking at the initial potential target and I'm comparing that to where my stop loss needs to be. Is there a sufficient risk reward to place the trade? Yes or no? And number two, okay, I need to scale out. the main job of this trade has been completed. So I scale out a little bit, and then I wait to see if the market can deliver more, because then we're looking for continuation. So in this case, the market does continue, okay, on its way down. And it goes through, now we're down from around, we said 33.75, 33.80, we're down to 33.30s, 40s, okay? And compared to our stop loss, we're about 2 to 1. So, and we start to see stalling action, okay? So once again, loss of momentum, inside candles, loss of momentum. And notice here that I'm observing all this, I'm managing all this on the same time frame that I initiated the trade from. And this is another key, okay? Your trade management should happen. You should conduct it on the same time frame with which you execute your trades. So if you execute from a 15-minute, you manage from a 15-minute. If you execute from an hourly, manage on an hourly. If you execute on a 4-hour or a daily, you've got to manage from a 4-hour or a daily, at least initially. And then if the trade matures and or the trade goes aggressively in your favor, we'll see what happens, because there was an example just the other day. So notice stalling action, okay? Stalling action, and also this is kind of the opposite kind of signal, right? We got in with an inside bar and an overbought CCI. Now we're getting inside bars with an oversold CCI. So opposite signal and stalling action, scale out. Okay, you're taking a bit more risk off. At this point in time, you can probably trail the stop to break even, just a bit better to break even. And you're managing your risk well. Okay, you're in a profitable position, and you're holding the rest of the trade, looking for the final profit target. Because of course, these black lines here were the objective targets for these trades, looking on the 15-minute. Okay, so we're not really looking for impossible risk-to-reward ratios here. We're looking at very logical risk-to-reward ratios that should be achievable if the trade wants to work. Okay, so 1 and 2 have been done, and now we're holding below. Let's see if the trade can go down even further. So what happened here is it actually gave us the possibility to add to the position. Okay, so it pulled back, and after the pullback, it gave us another entry signal. So you have the high CCI, and you have an inside candle here. So shorting through the inside candle, placing another stop loss just above here, for example, because at this point you do have a clear swing high for protection. And to pyramid, when you pyramid like this, just a little note, a trick. This is a trick for you. Pyramid entries should, in this case, it was half size or 1/n open position. So we had 1 open position. This is the second. So half, 1/2. 2 positions, half the initial size. If we had 3 positions open, okay, we were opening the third, it would be 1/3 initial size. Because this way, the pyramid remains heavy at the base, and you don't start creating heavier positions all the way down. You create lighter positions, but you're still giving yourself the opportunity to benefit from the wiggles of the market, from the pullbacks as the market goes about its business. Okay, so this is it's a trick. I don't know on the web where you'll see this, but it's a trick from the professional realm. When you scale in, when you add to your positions, add with 1/n. And we have basically the same kind of scale out. Okay, so I added this black line here because this was the swing low from which we were pulling back. So obviously, our objective with the add-in entry, and now our objective on any other intraday shorts, are to get back down there initially. And we almost do. Okay, but then what happens is we have an inside bar, with a low CCI. It's exactly the same situation that we had here and that got us in the market in these 2 situations. So what you do is you scale out. You're scaling out of your add-in, okay, and you're holding 1/3 up here and 2/3 here. So you've got a sizable chunk still in the market, and you've already taken out multiple bits and pieces. So you're doing an excellent job of managing your risk. And finally, what happens is the market comes all the way down and hits the target. So you have the full profit down here, 133, on your last third of the position up here, and on 2/3 of this position. This is real world trading. And as you've seen, I did this in real time. I took these screenshots in real time as they were happening. So I'm not really inventing anything. I'm showing you in real time what the reasoning was. Let's go on to another example. This happened this week, just this week, after cable, after the bad news over the weekend, Brexit jitters, blah, blah, blah. If you've been following our morning notes, you know all about it. So short into yesterday, or it was the day before yesterday, so Tuesday. Short into Tuesday. How do we manage the trade? Intraday objective. And actually, I know one of my students was on this trade. I was on this as well. And the initial signal is basically the same. CCI approaching overbought. In this case, it didn't really reach it, but we had a strong rejection candle on the 15-minute chart. So, the market on the intraday charts is already trending down. We have a situation where the daily chart is also trending down with lower highs and lower lows. So we've got a strong trend behind us, and we get this nice rejection candle. So that's the entry signal. We're shorting below it. Now, I didn't take any intermediate screenshots until here because the market really hadn't done anything that warranted a change. Okay, there were no inside bars with the oversold CCIs. There were no inside bars with the overbought CCIs to add to the position. There was nothing else to do. The market traded through the first target at 31.15, and we're still holding and waiting to see what happens. Full position, still on. We're holding. The market goes down more. It's reaching our second potential profit target at 30.60. And we're holding the full position. Now, I want you guys to know that this is the hardest thing to do in the market. It's to hold a full position, okay, when it's going strongly in your favor. It's the hardest thing to do. Much harder than cutting losses, much harder than taking losses. It's the hardest thing to do because you've got the full position on and you have to remain balanced and objective. And in my experience, the only way to do it is to focus on the process. So as the market is printing these candles, okay, as the market is going about its business, looking at each candle close, of course, unless there are big spikes or something that goes against you or news, you're always asking yourself, is there a necessity to manage the trade? Is there, for example, an inside bar, a loss of momentum, a rejection, a spike rejection? Is there some signal that is telling me to scale out or to protect myself a little bit? Because if there isn't, then you got to hold and milk the trade, because these are those home runs that will make up for a series of losses. So now we can talk about what happens if you have an aggressive runner going in your favor. Okay, what you do is if the market is aggressive, you have to be aggressive. It makes sense. It's logical. So one thing that you could do, one thing that I do and that I did, and I'll show you, is to drop down to a smaller time frame and manage, just manage by looking at the peak trough behavior and keeping your stop loss beyond the most recent peak or trough. Now in this case, we didn't really have a peak trough. It was a consolidation break. So the most recent trailing stop is here above the consolidation breakout. And what we're doing is we're just trailing our stops now from this time frame because the market has gone above and beyond our expectations. So in order to not give too much back, okay, this is the key. We're trying to not give too much back, but at the same time, we're letting the market go about its business. So instead of trying to pick a bottom, we're letting the market tell us when it is bottoming. And so let's see what happens. The market progressed even further through the target. Then it pulled back and it produced a lower swing high. So as the market produced that swing high, I lowered my trailing stop and you've locked in a bit more profit. So let's see what happens. Let's see if we can continue going down. Okay, we're not, remember, the trade is protected. You know, we don't have to do anything else. We're in profit. We are just sitting on a profitable position with our trailing stop nicely in profit with a much, you know, this is a 3-to-1 risk reward more or less at this point in time. And the market pulls back again and makes a lower swing high, so we can lower the trailing stop even more. And I think this was the last screenshot that I made, yeah, because eventually the market just popped in and took out the trailing stop. It eventually, you know, continued into the next day, but that's in hindsight, and you don't know that. And if you're trading intraday, you don't really care about what happens, you know, on a multi-day basis. You know, you're trading your stop intraday, milking the intraday move as much as possible. So this is once again, was a great trade. We actually called this live on the Twitter feed. We suggested the short sterling on that day. So you know, we're nice and lucky, and when this happens, at least now you know what to do in order to milk the trade and not dilute your profit targets. This here was instead a trade that another student of mine took on the same day. So it was still basically a play on dollar weakness. I'm just going to have a sip of tea, and I'll be right back. Okay, there we go. So this situation here was, it was interesting because it shows you what real world trading is about. Okay, real world trading is not neat and tidy. It's about a battle. Okay, so you have to expect a battle. Don't expect your trades to perform in an orderly fashion. And that's why you need, you know, your trade management tools so that you can confront the markets based on what they are doing and not based on what we hope they would do. So entry, student's entry was here. The usual inside candle, low CCI, pulling back to a confluence zone. So in this case, this was previous week's high and, you know, previous day's high, a little zone here. The market goes into there, produces the inside candle, and that was the initial signal. So what are the, you know, if we look at the levels, what can we expect? Well, initially, you know, the market needs to at least transact these highs, the intraday highs. It's tight, but then again, we're trading intraday, so, you know, get used to tight targets. And then the second one is at the 92 figure. Okay, a round number. And round numbers, as we know, are usually psychological points where there's a bundle of orders, different orders. So here's what happened. After the initial entry, the market went up to the initial target. However, it printed an inside bar. And as we know, loss of momentum, we have to protect the trade. So you take a piece out. And it looked like that was it. It looked like, you know, this trade was due for a loss of 2/3 of our initial risk after that scale out, but that's fine because, you know, we're not losing a full, you know, 1R. We're only losing 66% of it. So we're doing a good job of managing our risk in any case. And the market instead continued, went up to the target, but there was no, you know, there really was no other signal here to manage the trade because the market started to come back down aggressively with this kind of, you know, engulfing reversal signal on the 15-minute chart. So that was the signal to actually just close the trade there because it is clearly reversing momentum, you know, off of a potential target zone, round number, and, you know, that's just, you know, that's it. So on this particular trade, no home run, not a loss, small profit. Okay, but still you're managing your risk correctly. And in this case, you know, the student did manage his risk correctly because you never know what's going to happen. You know, you can't sit on a trade after seeing objective reversal behavior and, you know, expect it to continue and just turn around. That's holding and hoping. That's not what we're talking about here. We're talking about managing your trades based on what you see, based on what happens. Okay. So now let's talk about managing your trades from a swing point of view. So we're going to use exactly the same method, exactly the same principles, just that this time it's on an hourly chart. It's not on a 15-minute chart, not on the intraday scale, it's on the hourly scale. So in this case, your targets are, instead of being intraday, they're intra-week. So instead of looking at, the previous days, at levels within the previous day's range, you're looking at levels within the current or the previous week's range. Okay, but the logic remains exactly the same. Here we're coming from a deep pullback, oversold CCI, plus we get our inside candle, and in this case, coming from the strong downwards momentum with the consolidation area, I just thought it was more prudent to wait for at least a higher low after the inside bar and a push through that. So I'm hypothesizing this trade initiated around here. This is on gold. Okay, so I took the screenshot on gold, and let's see what happened. So after the initial entry, the trade progressed, but it stalled. So this is one of those situations where you can ask yourself, should I take some risk off the table? Okay, this is going nowhere. It's in profit, but it hasn't gone anywhere for a couple of sessions. Okay, Asia and Europe, it's done nothing. So what do? We are basically halfway between our entry and our target. Anything could happen. So you can study the situations, but there really is no right answer here. It's a freeloader. It's not doing anything for you, but it's not going against you. So it's a 50-50 shot. Whether you scale out a little bit, I wouldn't close the trade, okay, because the trade is still in profit. So I wouldn't close it. Reduce risk, sure. Trail stop to par, not really, because you don't have another pullback swing low to trail your stop towards. So the thing could actually pull back towards these levels and then rebound. So it's it's one of those gray areas where you will have to test, and using the same principles time after time, you'll have to identify whether it works for you. One idea could be, when you're in doubt, manage your risk, take a bit off the table, or if your stop was way down here, you could trail it just a bit tighter. So in any case, you're not risking 1R. That is, as long as you're doing that, then you're doing a good job. Okay, trail your stop. Remember, having the tighter stop loss is an edge. Whatever happens, as long as your average loss isn't 1R, as long as your average loss is smaller than that, then you're doing a good job at managing your risk. So that's the principle. Prices start to chop around, do something that's not really interesting. Think about your stop loss, manage your risk. What is the most logical thing to do? Okay, not the the most psychologically soothing thing to do, which would be to take full profit and say, okay, well, a profit's a profit, whatever. That's incorrect. Manage your risk, but don't act emotionally. So let's see what happened after this. After this, the market actually came back down. It tried to probe towards the entry, but it offered another. So we have a rejection candle here with an inside body. So it's our usual, inside body signal with a low CCI. So hypothesize adding to your position. Okay, so we're adding half of the initial risk. And we're able to add because this is above our initial entry point. Okay, you never add if you're below the initial entry point. Always add when the market's going in your favor. So add, and we reached the first target. So we are definitely scaling out aggressively. 1/3 of this, 1/3 of this is scaled out. And then the market produces something else that we're paying attention to, which is a loss of momentum. So you have the inside candles here, but looky, you also have a divergence in momentum. The divergence is simply you have higher closing prices on your charts, but momentum is forming a lower high. So you have higher closing prices, lower highs in momentum. That's a negative divergence, and it's alerting you to a potential shift. So you scale out a bit more on this negative divergence. Okay, we're managing risk. It's not about holding and hoping the thing can go even further. It's managing risk. We're looking at objective signals here that are saying momentum is starting to decline. The market pulls back, and by the way, we can trail our stop loss at this point here. When the market reaches our first target, we can trail our stop loss below the most recent swing low. Okay, because at this point in time, it just makes sense. So we are just above break even on the first entry, and we are, and we're essentially we're using the same stop loss that we did on the second entry, but at least we've scaled out. So we're managing risk. And the market comes back down on this other pullback, and when it prints the higher high here on this particular candle, these lows emerge as stop loss a bit on that, because we never know what's going to happen. And I think, okay, the next screenshot obviously was because the stop loss was hit. So we did a good job protecting our risk. We managed the trade when it was in profit, and we're still up. Okay, we're trading the markets as they present themselves. And as you noticed, I'm showing you, basically real-time developments as the market was going on, because this is what happens in real time. In trading, it's never clear, cut, and dry. It's almost always like this. It's almost always a battle. So what are the principles that we've used to manage these trades, whether intraday or swing? Number one, you have to decide your objective. Do you have the time to be an intraday trader? Or do you need to manage your trades from a swing perspective? Or do you just want to do this basically part-time and just manage them from a position perspective? Notice one thing, however. The further out on the time frame, on the time scale you go, the larger the stop losses are going to be. So in order to keep your risk at the fixed fraction of 0.25 or 0.5%, you need to have sizable accounts in certain conditions, because if you're managing a position trade, okay, you're getting into a position trade, usually on daily charts, you might have 100 or 200 pip stop loss depending on what you're trading. And if you have to fit that 200 pips into 0.5% or 0.25%, you do need a larger account. So usually what happens is that smaller accounts stick to intraday or swing, and then they can expand as they grow in experience as well. They can expand out the position. But that's just what happens. It's a trade-off. So your positions are going to be much smaller if you're position trading. They're going to be much larger if you're trading intraday. The trade frequency is higher if you're trading intraday. The trade frequency is intermediate if you're trading swing, and if it's slower if you're trading position. So your objectives have a lot to do with your time availability, but also your personality as a trader. Some people are just wired to trade in and out all day, and some people are wired to be more patient and more conservative. So the first thing is to decide on your objectives without forcing things. Trading initially, until you make the cut, until you transition to the professional side, trading has to fit into your day. Okay, it shouldn't be your day rotating around trading. Second thing, your initial risk to reward, okay, logical risk to reward, not what we want, not what we are hoping for, but the initial risk reward, take into consideration levels that are clearly discernible from your execution time frame, should give you at least a 2-to-1 risk to reward or better. Okay, so we're trying to give ourselves space. The market should have space to run. Third thing, manage your trades from the execution time frame. Okay, until or unless they go running on you, like we saw in the cable example. In that case, sure, drop down to a smaller time frame and trail. Use a trailing stop, on swing highs or swing lows if you're going up, or using a moving average or a SAR, a super trend. Any of those tools will fit the bill. whatever you prefer. The preference is personal, but at least you're trying to run your trades and give them space to mature. Also, we use the principle of scaling out, reducing our risk on reversal signals or losses of momentum. Okay, because the principle here that we're using is we want to be in the market as long as the market is producing an efficient and effective run. Okay, it's doing something that we want. If not, if we see divergences or the inside candles, etc., then we can scale out because there's a loss of momentum. Something is changing. And finally, if you are going to add to your position, if the market gives you further opportunities to add to your position, don't add a full amount. Add 1/n. So that means if you have one position in the market, then you're adding half a position. If you have two positions in the market, then you're adding a third, etc., etc. And the additional entries are only allowed if the entry price is higher than the initial entry in an uptrend. Okay, vice versa in a downtrend. The whole idea here is to let the market deal you out. Okay, let the market tell you when the situation is changing. Don't force your view on the market. Just let the market tell you. And if you can do this, if you can let the market really run and mature on those trades like cable this week that just run on and on and on, you will be in a more relaxed position because when you do make those 3-4 hour trades, you can now lose 4 times in a row, 1 full hour. Okay, so you can do a lousy risk management job, lose 4 times in a row, and just break even. Okay, that is, and if you have historically a 50% win rate, the odds of you losing 4 times in a row is very low. So, you're in a great position. But if you never run your trades, okay, if you're always taking, 0.5, 0.75, 0.9 R, and your losses are 1 R, you're running a negative expectancy. Okay, or at least even if your expectancy is positive because of a win rate, you're running a negative skew strategy, which is not a position that you want to be in. Okay, so going forward, let's talk about a bit of the math behind trade management. Okay, let me just have another sip of tea or my voice will go away. Okay, ultimately, as soon as we deploy risk capital in the market, our job should be to limit risk and manage it in the most efficient way possible. Okay, so efficient risk taking means that you're able to generate higher returns per unit of risk. Okay, this means essentially translated Sharpe ratios above 1. Okay, what is a Sharpe ratio? What does it mean to generate a higher return per unit of risk? What is a unit of risk? Mathematically speaking, in finance, unit of risk is standard deviation. So what the Sharpe ratio does is it gives you that information. How efficient is this trader's risk taking? Because if I have a Sharpe ratio of 1.5, let's say, it means that on average, I'm returning 1.5 times my unit of risk on my trades. So I'm doing a good job. I'm an efficient risk manager. Okay, and that's why to be funded at FCI Markets, we require traders to have Sharpe ratios above 1. Okay, in order to qualify, you need to have a Sharpe ratio above 1 because that's the minimum requirement. That's the entry requirement because it tells us that you are an efficient risk manager and that you're stalking and executing and managing trades that deliver, higher risk rewards, and you're not taking subpar opportunities. You're letting them just pass by you. You don't get interested. You don't risk your money in the markets unless you really think it's worth it. So some ingredients, some necessary ingredients that help you get that Sharpe ratio above 1 is having the average profit to average loss, which is around 2. 3 is ideal. 2 is what you should aim for at least. And how you do that is through your stop loss and your trade management. So, if you're managing your trades, if you're only taking high probability trade scenarios and you're managing them in an efficient way, it should be difficult to get you into a difficult position. You should be, as you battle it out day after day, you'll have scratch trades, small profits, scratch trades, the occasional nice winner, scratch trades, small profits, scratch trades, the occasional loss that you have to take, and then, the occasional big winner, loss. But on average, you're skewed to the positive side with the small profits and the occasional runner, and they more than compensate for the losses that you're taking. And on the stop loss side, you are probably trading your stop losses, and you're not allowing the market to stop you out at 1 hour. You're always cutting your losses as soon as possible. The other thing is that losses must be less frequent compared to your gains. Okay, so how do we do this? Okay, now I know that we talked about not clinging to a high win rate. Okay, but this is not clinging to a high win rate. The win rate, as we talked about in the previous webinar, the win rate depends on your trading model, on your entry signal. So how do we try and get a higher win rate without forcing things and without actually, clinging to the high win rate? It's simply trading when the markets are doing something that suits your system. If you're a trend follower, right, then select only the best markets that are trending the best, right? End of story. Don't get involved in markets that aren't trending. Don't get involved when something doesn't feel right. Only get involved when the market is producing, an environment that's conducive to your system. If you're a mean reversion trader, only trade mean reversion when you've had an extended run to the upside or the downside, or when the markets are trading within a defined range. Don't trade mean reversion when you're in a strong trend, and perhaps only wait for certain signals to appear, certain exhaustion signals. So whatever it is, try and stack the odds, the known odds, the things that you can see ahead of time. So, for example, volatility, extended moves, trendiness, market drivers, which tell you a lot about the market psychology. These are all things that you can use to sort of skew the odds in your favor, and help generate higher quality signals. And that's how you can try and limit the losses. So this is where having a rules-based discretionary trading model can have some advantages over a pure systematic model, because you can filter out situations. And the third thing is you must have some home runs. You really need to have some of those trades, just run and you manage them lazily, letting them mature and not being in any rush to cut your profits. Okay, and that is trade management. So you see, the trade management is important because it pops up in the average profit, average loss ratio, and in the home runs, and it's just it is a necessary ingredient. Without knowing how to manage your trades, you really are at a disadvantage. So here are some practical tips. If your trading style is mean reversion, number one, use a stop loss, because it seems that most retail traders don't. Second thing is allow your winners to mature. Okay, so mean reversion, usually you have hard profit targets. Try scaling out 2/3 of your position at that profit target and let the rest run. Okay, try and get the bigger win. And manage that last 1/3 so that you don't give back too much if it does run. If your style is trend following, then get used to the idea of having trailing stops, okay, and having time exits for trades that doing something like gold, with the gold example we saw, when it's going sideways for a certain amount of time, get the idea of not keeping your capital locked up in trades that aren't really performing that well. And also try to improve the win rate, because trend following, the systematic trend followers are the main example here. They have horrible win rates, even though they're profitable over time. However, a lot of what we don't see is that the graveyard of trend following models is full. So, you need to try and have a 50% win rate, even if you're trend following. How do you do that? Well, stack the odds. Wait for the best situations, and and learn what complements your trading model. To conclude, whatever you do should be process guided. Okay, so even the examples that I gave you of trade management in this webinar, they're a recipe, and you can take that recipe, take that process, and apply it, or you can create your own process. You can compare it, study other ideas, whatever it is, but have a process, because it's not about the money. Okay, trading is not about the money. If you focus on the money, you'll never be a profitable trader. So you need to focus on the process. Okay, and by all means, take our cues, take our suggestions, but then create a process that you enjoy, that makes sense to you. Study your process. Okay, study your trading logs, your records, what you're doing well, what you're doing poorly, where you can improve, and enhance it. Because only if you have a process can you actually analyze over time and improve over time, because what's what's working, what's not, and whether the process is working to your strengths or not. Okay, because we're all wired differently. We have to work to our strengths, or our strengths will block us. And you're never trading emotionally, because you're just following your process. Okay, so the process-oriented goals are what will keep you from trading emotionally and doing what most traders do. But most traders lose money in the markets, and we want to be different. To be different, we have to do things that most people won't, or that most people can't, in order to achieve what most people simply can't. So if you need guidance, or if you need further assistance on your path to consistency, sign up to our blog, news.fci-markets.co.uk. Click on the subscribe box and leave your details in there. And you can get our morning calls and blog posts, updates, recordings, everything directly into your inbox. Follow our Twitter feed, as we put out just the most influential market information and chart analysis. And then, if you're really serious, you can come to the Professional Trading Academy and qualify for a fully funded account. Just go on to fci-markets.co.uk/academy, and you will see what the requirements are. You'll see what is being taught, what I'm teaching at the academy, and how the funding process works for people that don't have a track record and that come through the academy to build a track record and then qualify for a funded account. Because ultimately, that's our goal. Like I said at the beginning, everything that we do here at FCI Markets is oriented to helping you become a professional trader. End of story. So, please get in touch in any way you feel is most adequate for your situation, and let us help you. Let us guide you towards a successful trading career. So finally, if you have anything to ask, you can call us up or send us an email to client.support@fci-markets.co.uk. We've been going for over an hour now. I thank you once again for sticking with me. I hope it was interesting, and I'm just going to open up the floor to questions. A decent question from Gavin. Excuse me. So he says, when calculating R, so the risk to reward, do you allow for position size? For example, if a standard entry is 1% risk, and a full loss is 1R. That's obviously a 1% loss. But if you enter half a position, would a full loss be 0.5R, or would it still count for 1R? No, I personally use 1R. So if I'm risking 0.5%, that is 1R. If I'm risking 0.25%, that's 1R. I hardly ever, actually, I never risked 1% because in all of my trade management simulations and drawdown simulations, risking anything above 1% basically transforms the risk of ruin into non-negligible. So I've learned that the math behind the risk of ruin requires that you keep your risk to below 1%, especially if you're trading intraday. But beyond that, yes, whatever you risk, so whether it's 0.5%, 0.25, the 1R, that's 1R. Okay, so if I'm risking 0.5%, I need to make 0.5% to make 1R. If I'm risking 0.25%, I need to make 0.25 to make 1R. It's symmetrical. Okay, position sizing in MT4. I should say, or MT5, because we use MT5. There are position sizing calculators out there. I know that for MT4 there are all sorts of calculators that people have programmed. So the choice is personal. If there are some calculators, like my FX book has a decent calculator because it works. I mean, they've added a lot of indices and also CFDs into their roster. So my FX book calculator is a decent one to use. But the choice is personal as long as you are calculating your position size. So as long as you are, you're not throwing in, let's say, one mini lot, just to make things simple, one mini lot, so 10,000. As long as you're not just throwing in random position sizes, but you are tailoring the position size to the size of the stop loss, you're doing a good job. Okay, you don't need to be pip precise at the beginning, but as long as you got the principle correct and you are trying to size your positions consistently, then you're doing a good job. I'm not in a position right now to suggest any particular calculators, but if you write us, write us to client.support@fci-markets.co.uk. Perhaps we can give you a few suggestions, but as far as I know, we don't have any commercial interest in sponsoring one calculator over another. So that's why I just suggest, my FX book has a free one, and it's something that I use, for example. I still use it. So it's it's easy enough to use. That's I hope I answered your question there. Another observation, another client is saying, why doesn't anybody tell me how to manage my trades? Well, it's a good question. And the answer is that nobody can tell you how you should trade. I know we all want to have set and forget models where you know exactly what to do, just let the trade run and do whatever it has to do. But trading, profitable trading is very personal. Unless you've built a purely systematic model, but they are tremendously difficult to program. Okay, automated trading is the Formula One of trading the markets, or it's the the MotoGP of trading the markets. It's highly sophisticated, especially if you want to trade higher frequency. Even if what the actual bots do is simple, the programming is very complex. So the answer is every person has different strengths and weaknesses. Okay, every person has different time availabilities. And so your trade management has to reflect all of this. At the same time, the trade management has to be based on solid principles, which are trying to run your profits and cut your losses. So you will need to find those tools and those approaches that best resonate with you, that allow you to do this, and you test it on a simulator, on a demo account, time and time again, not with hindsight, but in real time. You test it, right? If the principles are sound, they will stand up to inspection, and they will allow you to tweak them, gradually as you gain experience and statistics. That's why I always suggest even to my coaching students, whether they're coaching students or academy students, they need to attach even their demo accounts to MyFXBook or FXStat or some independent monitoring program, because we need to use the statistics. We need to evaluate the statistics to learn what has to be improved, and what instead is working well. Okay, you need the cold hard data, but you also need to be consistent in your approach. If you are always changing approach, you'll never know, what works well and what doesn't. So you stick with an approach, and based on principles, based on logical principles, make those incremental changes based on your data. Okay, and I'd say like 20 trades at a time. Take samples of 20 trades. Then you make your conclusions. Make a little adjustment. Next 20 trades. Conclusion, adjustment, 20 trades. It can be a lengthy process, and that's why back testing is useful. But it needs to be done. It's the only way you're actually going to learn, because there is no guaranteed recipe that will work for everybody. And there especially is no guaranteed recipe to make money in the markets. We are very much professional gamblers. So that's why the mindset that we have to adopt is the mindset of a gambler. Cut your losses, only bet when the odds are in your favor, strongly in your favor as much as possible. And try and run your winners when they're there, and try and cut your losses as soon as possible. Now, I guess the benefit we have over gambling is that it's not all in. It's not like a win or lose situation. You can drip feed your risk capital into the markets, and your wins and losses can be, they can be in between. They don't have to be like full 1 hour loss or 1 hour gain. They can be multiple hour gain and a fraction of an hour loss, which is what it should be. And so on and so forth. So there are advantages in trading compared to gambling. But yeah, you have to have a process, just like all the professional gamblers have a process. They don't just throw money on the table. And knowing how to manage your trades is personal. I've given you some solid principles that I use. They can help you. But if you find, you can also find your own way. You can find your own, whatever benefits you the most. All right, if there are no other questions, I will just wrap this up, and I'll say thank you, everyone, for coming. It is, as usual, an honor to be in a position to be able to help you with your trading, and to be here, in front of a public doing this. I really hope that it helps, and as usual, I look forward to seeing you in our next webinar, but also, at our academy, or, on our blog, or get in touch on social. We're here to help. So if you have any questions, don't stick to yourself. Don't try and answer the questions yourself, but always, reach out to us, because your success means, we're successful too as a business, because we're your team. And that's that. So good luck with your trading. And this is Justin Paolini